Almost 2000 years ago, in 33 AD, the mighty Roman Empire was facing a financial disaster brought about by a liquidity crunch faced by its major banks. A combination of bad loans and falling real estate prices created a liquidity crunch that started forcing many banks to shut their doors. Emperor Tiberius intervened and decreed that 100 million sesterces were to be taken from the imperial treasury and distributed among reliable bankers to be loaned to the neediest debtors. In other words, a bank bailout. Yes, the first bank bailout in history happened more than 2000 years ago in 33 AD in ancient Rome. Welcome to the Why in History. I am Ajay Kaul, and today we take a look at money and its evolution from ancient times to the modern day. One of the earliest forms of money was the barter system. This essentially entailed exchange of goods and services based on demand within the community. So within a community or a village, different individuals took on different trades and exchanged the output with each other based on the demand. But as population started increasing and trade started expanding beyond a tribe or a village, the system was not scalable. The primary issues were the exchange rate between the goods being exchanged and finding a buyer for your product who was selling the same product that you wanted to buy. So this led to the birth of commodity money. That is, using a specific commodity as a common medium of exchange for conducting a transaction. So in ancient Rome, salt was used as the commodity money. Aztecs used cacao beans, and Africa and China used seashells. The commodity money needed to have some characteristics to make it a viable option as a trade currency. The key characteristics that the commodity money needed to have was 1, it was scarce, 2, it was easily recognizable, 3, it was easily divisible, 4, it was fungible, that is, you could substitute one piece for another, and 5, it was portable. Now, portability was a big issue. You could not go around carrying sacks and sacks of salt or cacao beans to a market to buy something that you were interested in. The scarcity factor was another major issue with respect to commodity money. For example, a bad cacao crop could throw the entire currency in turmoil, or a new discovery of salt could make the currency less valuable. So a new system was needed, and about 2,500 years ago, China and Turkey became the first regions to come up with metal coins. And around 640 BCE, metal coins started appearing in India as well. The first official metal currency was minted in the kingdom of Lydia, which is modern-day Western Turkey, around 700 BCE. The Lydian lion was made of an electrum alloy, which was a combination of silver and gold. So the birth of money, as we understand it today, really happened with the metallic coin as the medium of exchange. And its biggest advantage was that it carried its own value because of its composition. And subsequently, the metallic coin became the standard medium of exchange for any kind of goods and services. And this meant that trade could finally expand beyond domestic boundaries. In other words, trade was now global. Now, because the coins were minted by the royal treasury, the kings and their administrations became all powerful because they were able to control the money supply. The metal coins too had their drawbacks, and the prominent one being that you had to be careful that somebody had not tinkered with the underlying metal to reduce the intrinsic value of the coin. So someone could have removed about 10 cents worth of metal from a 50-cent coin without you realizing that you had actually a 40-cent coin in your hand. Wait, but wouldn't that be an issue even today? Not really, because today coins come milled. Milling is the process of cutting up and down grooves around the edges of the coin. So all modern day coins undergo the process of milling, which creates the grooved pattern along their edges. And if anybody tampers with this coin, it will end up tampering the grooved pattern itself. So that tampering would be very visible. So while the world was carrying out a lot of its trade using the metal coins, around 780 during the Tang Dynasty in China, there was some form of paper money like bills and credit notes in circulation. But paper money in China took an official form only during the Song Dynasty around 1100 AD. And Europe became aware of the concept of paper money through the explorer Marco Polo when he returned from his travel to Asia around the year 1200 AD. The concept of finance and lending has existed for centuries. In fact, in the earliest civilizations like Mesopotamia in 2000 BCE, you come across the concept very similar to that of payday loans, wherein farmers would borrow seeds against a later payment. The Code of Hammurabi also talks about a price table which was backed by the authority of the king that regulated the amount of interest charged on loans of silver. In ancient India, around 320 BCE, under the Maurya dynasty, instruments called adesha required bankers holding them to pay the value of the note to a third party. This was one of the earliest recorded examples of a bill of exchange. However, if we go purely by the present-day banking conventions, the birthplace of modern banking was Italy, specifically Venice. It was the Jews living in the ghettos in Venice who developed the banking practices around merchant banking. They started working with the established Italian grain merchants and merchandising centers to set up the infrastructure for an interest-based lending system. Why the Jews? Well, at the time, charging an interest was forbidden to the Christians. And the equation between the money-lending Jews and their customers is well captured by William Shakespeare in The Merchant of Venice, with Shylock being the money-lending Jew. The money-lending transactions in Venice were conducted on a bench or banco, and that is the origin of the word bank. The business of financing would have stayed with the Jews had it not been for one family in the neighboring Florence that legitimized modern-day banking. It was the Medici who set up the Bank of Medici in Florence in the year 1397. The Bank of Medici operated branches all over Western Europe, from Rome to Barcelona and even London, and the Medici were able to avoid the gates of hell by using an instrument called the bill of exchange, which generated profit based on the exchange rate differential across various regions instead of charging an interest. The bill of exchange is an IOU or a promissory note, essentially a promise to pay the holder of the note a certain amount. And the Medici started acting like a clearinghouse for these notes. So the traders no longer needed to transport gold coins or other currencies across regions to complete a business transaction. So a trader in London ordered 100 gold coins worth of cloth from the Medici and issued an IOU of 100 gold coins to the Medici. The Medici ordered the cloth from someone in France and passed the 100 gold coin IOU to that trader. So all of a sudden, business transactions started getting carried out on these promissory notes. The actual physical currency was no longer a requirement, primarily because these traders trusted the Medici to fulfill the promise made in the promissory note. And trust became the centerpiece in the business of credit. Credo in Latin means I believe, and that was the root of the word credit. So all of a sudden, the IOUs became more powerful than the gold coins themselves, and as a result, lenders became more powerful than royalty itself. And being at the center of European trade, the Medici rose in power and prominence, enough to have 2 Medici become queens of France and 3 become the Pope. And the Medici also ended up becoming one of the major patrons of the Renaissance. So as paper IOUs became popular, the one business community that took full advantage of this were the goldsmiths. The goldsmiths already had a lot of gold that they were storing for their customers, and they realized that they could start lending this out and charge an interest. And what was even better was that they didn't even need to lend out the actual gold. All they had to do was issue an IOU with a promise to pay. And subsequently, more and more of this paper money from private bankers and goldsmiths started circulating, and it began to rival the crown's own gold coins. And things came to such a head that the British government found it difficult to raise money to wage a war against the French king Louis XIV. So in 1694, the Bank of England was established as the central bank of the United Kingdom, and its first order of business was to issue banknotes to the amount of £1.2 million to finance the war against France. The banknotes were purchased by about 1,200 members of the general public, and they were promised an 8% interest rate. And with this, the concept of sovereign debt was born. Interestingly, the Bank of England stayed a private institution till 1946, when it was nationalized. In the United States, Congress passed the first Coinage Act in 1792, giving the United States Mint responsibility for creating coins for public use. Overall, there wasn't much monetary oversight, and the system operated without any major issues till the Panic of 1907. The bank panic of 1907 was a short-lived liquidity crisis in the US that resulted from the collapse of highly speculative investments, which were made easy by the lax monetary policies followed by the US Treasury. This led to runs on New York banks and trust companies that had been financing these risky investments, and that led to a big shrinkage of liquidity in the markets. A bank run happens when a large number of customers of a bank withdraw their deposits simultaneously because of concerns about the solvency of the bank. And many times, the banks may not have enough cash reserves to service these withdrawals, and that essentially is termed a bank run. And because of the lack of a central bank at that time, Wall Street turned to one of the leading financiers of that time, JP Morgan, to steer the country through the crisis to prevent an economic depression. JP Morgan was able to direct all the big players within the monetary system to divert their capital into the system so that all the banks could be kept afloat till the panic passed. And since a private bank had been able to save the day, the government realized that a central bank was needed, and they sent top bankers and government officials to Europe between 1907 and 1913 to understand how central banking was being handled in Europe. The delegation came back with a positive impression, especially impressed with the German and the British systems, and Congress ultimately passed the 1913 Federal Reserve Act that created the current Federal Reserve System. The primary function of the Federal Reserve was to control the supply of the Federal Reserve note, or the dollar. The dollar was tied to gold, and it was felt that as long as the money supply was controlled, the boom and bust cycles would be contained. And everything seemed to be going smooth till 1929, when the Great Depression started. And this time, there was a gold run. So the average citizen was not interested in withdrawing their money from the banks, but instead wanted to exchange their cash for gold. And on the other hand, FDR was desperately looking for more dollars to pump into the economy. So FDR had to shut down the banks temporarily so that there was no chance of dollars being redeemed for gold. And in April of 1933, FDR passed an executive order that required all persons to deliver on or before May 1, 1933, all gold coins, gold bullion, and gold certificates owned by them to a Federal Reserve Bank branch or agency, or go to prison. And they were getting dollars at a fixed rate in exchange for the gold. The Fed expanded its reach and offered even better prices to foreign governments to sell their gold to the US Treasury in exchange for the dollar. And with this, the dollar ended up being more prevalent in global markets as well. The gold reserves in Fort Knox increased substantially, and FDR had enough gold reserves to print more money to invest back into the economy. At the end of World War II, most of the economies were shattered, except the United States. Suddenly, the trust in the US currency started increasing, and foreign governments started pegging their currencies to the US dollar, which could still be redeemed for gold. And rightfully so, because the US at that time owned half of the world's gold reserves. By 1966, global trade had expanded enough that there was a lot more US dollars in circulation than the amount of gold with the US Treasury. And subsequently, foreign governments started demanding gold in exchange of the dollar, questioning the actual value of the dollar itself. The US did not have enough gold in its reserves to be able to convert the dollar into gold. So in 1971, President Richard Nixon decoupled the value of the US dollar to gold. Now, the most important currency used in global trade was backed solely on trust in the US Treasury. Just like the words on the US dollar, "In God we trust," the key element backing the US dollar globally was trust in the United States. When it came to personal finance, one of the key innovations of the 20th century happened in 1950. In 1949, businessman Frank McNamara forgot his wallet while dining out at a New York City restaurant. In February 1950, he returned to the same restaurant with his partner Ralph Schneider, and when the bill arrived, McNamara paid with a small cardboard card, which is today known as the Diners Club card. At that time, you had to pay off your credit card balance at the end of each month, and it was not until the 1970s when Visa and MasterCard allowed customers to carry a balance from month to month, which also allowed them to start charging interest rates for the rollover. The real disruption with respect to money came around 2009 when a mysterious developer known by the alias Satoshi Nakamoto created Bitcoin. Now, Bitcoin is a digital currency which is earned by mining for it. Mining essentially means you're pooling your computing resources to a global network of computers to solve complex mathematical problems. Bitcoin essentially is a software protocol which is running on the computers within the Bitcoin network, and as the computing resources of a specific computer help in solving a problem, Bitcoin gets created in the digital wallet of that account. The transactions are captured and replicated across the entire network, which means a central ledger is maintained and updated with respect to transactions and account holders across the entire network. So why has it created so much of an uproar? The primary issue is that so far in the pre-Bitcoin era, money has been controlled by the central government. The Federal Reserve in each country has decided how much money to print and how much to circulate to maintain some control over the economy. But now, with this open source decentralized network, which is creating and maintaining monetary transactions, there is fear that over a period of time, central governments and federal reserves may lose their control over creation and distribution of money. And it is on this note that we end this section of the program. On to the quiz section. Question from the previous episode. Who is considered the father of the Industrial Revolution in America? The beginning of industrialization in the United States is usually pegged to the opening of a textile mill in Rhode Island in 1793 by an English immigrant, Samuel Slater. Slater had worked at one of the mills opened by Richard Arkwright, and despite laws prohibiting the emigration of textile workers, he was able to bring Arkwright's designs across the Atlantic. And subsequently, he built several other cotton mills in New England to be known as the father of the American Industrial Revolution. So the answer is C, Samuel Slater. Question for the current episode. What denomination US dollar bill is most in circulation? Is it A, the $20 bill, B, the $1 bill, C, the $50 bill, or D, the $100 bill? Once again, what denomination US dollar bill is most in circulation? A, the $20 bill, B, the $1 bill, C, the $50 bill, or D, the $100 bill? The answer will be provided in the next episode. That's all we have in the current episode. In the next episode, we take a look at the history of democracy, its evolution over time, and the challenges it faces in the current times. Till then, stay safe and keep looking for the why in history.